So the hardest part of being a startup founder is proving one, that your idea works, and then number two, scaling it so that it's able to grow, right? So finding the resources that allow you to scale. Now, in my view, I think that bank loans should be avoided at all costs by startup founders until you've reached a certain size and scale. At least at some point you're making regular income.
Yeah.
Do you agree with me? And if so, at what point should a startup actually seek a bank loan?
I totally agree with you that bank loans are probably not the right place for startups.
So the long form podcast, I should not come looking for money from you.
let me build my case. I think that the reason why banks have been under a lot of scrutiny for startup or our failure to provide startup funding is that the startup financing ecosystem in Rwanda and largely actually the rest of Africa is underdeveloped, right? So the ecosystem needs to be able to provide different types of funding for different levels of entrepreneurship. So as a startup, you need to be looking for seed financing, right? And that's from grants, that's from accelerators, that could be
Friends and
from
family.
friends and family, your own savings, because you're still at proof of concept stage. Your ideas are not yet tried and tested. And so why are you bringing in somebody else to test your ideas, right? Because you're putting that capital at risk. That's one. Then as the business grows, there are other sources of financing. Venture capital is one that is known the most. Now,
But
in
not here,
Rwanda,
not in Rwanda.
and that's what I'm saying, because the startup financing ecosystem just does not really exist, right? Venture capital funds are set up to take a lot more risk than banks can because it's people who set aside a fund and are looking to take on more risk because they also believe that when they exit, they're going to make a much bigger return when they exit. They're taking the risk that the business might fail, but that risk is that if they succeed, it will be huge returns, 3 times, 10 times, whatever. So that doesn't really exist, right? There are other alternative sources of financing that are not venture capital. There's public funding. Usually government set aside funds for startups, for early stage businesses, right? For banks, I mean, I can go back to, our basic 5 C's of lending and probably talk a little bit about all of them. You look at the character. So let's say in the long form, I'll look at Sunny and say, I can take a bet on Sunny. I'm willing to put in my money. But then there is the second C, which is the capital. I would want to understand what is it that Sunny has put in? What is his own skin in the game? So that if we're going down, it's not like he's going untouched, right? There's also something that he's losing. So it's not just the bank that's losing money, right? And most startups will come without any skin in the game. So they want the bank to take full risk. And unfortunately, we're not structured that way.
So when you talk about skin in the game, what exactly do you mean?
Skin in the game is what I was talking about, in the startup phase. Either you've put in your own savings, you've put in money from friends and family. Maybe you have even a grant is not skin in the game. Skin in the game is,
It's
what is it
your
that
personal risk.
What will Sunny lose if the long phone goes down? Or will you just go down? Will it go down and it's okay? Somebody else has lost money. For me, it's okay, right? Then there is the conditions. How well is the financing that you're requesting? How well is it structured for the needs that you have? And then the whole idea around collateral comes at the very end because that becomes a fallback position, right? I think the C I missed was on capacity. What is your capacity to repay? And sometimes, to be honest with you, because the idea hasn't been tried and tested, the market analysis probably hasn't been done well. The financial forecasts do not show that there's capacity to repay. We go back to the basics. We say, yes, I trust you, Sunny, but the numbers are not making sense. How do I put in bank money? Well, knowing that as a banker, guess what I'm investing? It's shareholders' capital, and it's also someone else's money, deposits, which they expect back.
Just to understand this, so let's assume that this person has character, has skin in the game, all those C's. What, obviously you want to get a certain return on investment. So when you're looking at, say, that person's business plan, right, the financial forecast, what kind of growth metrics are you looking at? Are you looking at, say, for example, 10% year-on-year growth projected? Is it 15%? Is it above the cost of the loan, which is, say, for example, it's 16% interest rate? Are you looking for, say, 15% interest rate, like growth year-on-year?
So it's not so much about the growth year-on-year, because unfortunately, when you're looking at growth, you're looking at, the P&L growth. Right?
What does that mean?
A profit and loss, right? How much profit are you making from your business year on year? Now, the reality about profit is that it's not the best indicator of the health of the business. Because we also see a lot of businesses which, when you look at the profit and loss accounts, they look very healthy. But guess what? The business is not able to generate cash.
What do you mean? How is that possible?
Good. So there are a lot of businesses that sell and rely, for example, on government payments, right? Government can take a long time to pay, right? So in the 3 months or even 6 months that the government has not yet paid you, in your profit and loss accounts, you're registering a sale as, maybe I sold to the government 200 million. My cost of sales was 100 million. So I made a 50% profit.
But the money
on
hasn't
paper,
hit the
it
account.
looks beautiful. There is no cash. So someone comes with those profit and loss account, and it looks really good on paper. And now I have given the best case scenario, which is government. But you could also supply to a company that you don't even know that it will survive the next 6 months or 1 year, and your cash will be trapped in that business, right? So there are certain ratios that we refer back to, aside from the growth rates of the business. So we look at things as, the debt service coverage ratios. It's a bit technical, but it comes from how much is your business able to repay this loan that you're requesting for. So that you get from the debt service coverage ratio. You look at efficiency ratios. How efficient is this business running? You look at the cash flow forecasts and test them to actually confirm that this business will be able to generate cash, because it's through that cash that you'll pay the bank.
Are you guys actually, other than you telling me this, are you literally doing this for every single loan? Because it seems like quite a long process. Is that, like, how is that? How do you guys do it so quickly?
There's technology. We rely on technology. We have models that we use to just key in, the financial information. So this is why, and this is specifically for businesses. Obviously, as a salaried customer, we wouldn't be asking you for your financial statements. We would probably ask you for your employment contract and check on your account that there's money coming through the account. So the decision can be taken a lot faster. Now, for businesses, you need to have audited financial statements. When you have those statements, you key them into, models that then help you to calculate these ratios. And you can see, by keying in that data, you're able to see this business is problematic. So you're able to also make the credit making decision quite fast. But also that just looks at the quantitative. There's obviously the qualitative information that we gather. Believe it or not, we ask a lot of questions for business people, like what's the reputation of this person? That first C I was talking about, character. You obviously have the credit reference bureau that you go to see, is this someone who has historically repaid the loan? We get a lot of market information about people. So we are very, very careful as custodians of people's money. well understanding that we're using people's money and we have the responsibility to make sure that whoever we are lending to will actually pay back the money, so that we are never in a situation where we can't give our depositors their
Mm.
money.